just going to record this so that people that miss out are able to check it in, or check it out, I should say. But just to kick us off, Afonso, would you be able to sort of share a little bit about your background, how you came to found NetNada, and sort of like the journey over the past 4 years, and what that's looks like?
Yeah, for sure. It will be my pleasure. Also, if anyone wants to kind of put in the chat what they want to get out of the session, I can tailor it a bit more as well. So I'm an environmental engineer from UNSW. I first learned about carbon accounting about 10 years ago, and since then it's been on the back of my mind on how you use certain things like spend-based data, how you do macroeconomics analysis. One of my professors was actually the guy who has a paper of what is carbon accounting. So it was pretty close to the source, and I've come to know this years later. And I had a mix of experience in technology while at uni and after I graduated. And NetNada was an attempt of trying to democratize the aspect of calculating emissions, and it slowly has grown into something more aligned with reporting, ESG strategy, physical risk, transition opportunities, and so forth. But at the start, it was that process of carbon accounting should be a commodity. It should be easy for everyone. How can you use technology to enable that?
Yeah, cool. Love that, Afonso. And please, if anyone has any questions, feel free to drop them in the chat. We've got time at the end for questions if not, but I know this is like a big topic that a lot of people are wanting to learn more about. Could you maybe just kick us off as well, Afonso, explaining a little bit more around the Australian Sustainability Reporting Standards, sort of like their significance? Obviously, mandatory climate reporting, tier 1, group 1, 2, 3 companies. Could you maybe like flesh that out a little bit so that we can have a bit more of a clear understanding of just what's going on?
No worries. Also in the chat, if anyone if you can post just a quick text, if you are either a consultant in this space, if you are working on an organization that wants to report, or just maybe as an individual trying to learn more to maybe pitch your services or trying to find a job in this area. If you can just spend 1 second doing that, I think it's like 10 of us in the call. It'll be really good. So it can be really personable to what I get from that. So global scenario, Europe leads the way when it comes to climate disclosures. When I say climate, is that the first disclosures they are being mandated in Europe as an example, and have been there for a couple of years. It's around climate, not sustainability. There's sustainability components, but most of it's about climate, decarbonization pathways, emissions, and the impact of climate change in your business. So this has been happening, and there's a couple of long-running merging frameworks of very bureaucratic process that kind of consolidated into TCFD, which is widely used. And then Australia went ahead and say, what are they doing in Europe? And what's this framework that everyone uses? We're going to adapt it to the Australian market. The other adaptation was very minor. They've excluded a couple of requirements. They changed a bit of text. They chose their rollout, but that's what we landed. Today, what's been published, it's 2 standards. One is climate related, which is the mandatory one. And the other one is sustainability related, which is overarching, but it's voluntary. Okay, so there's actually 2, not just one. People talk about what's called WASP S2. And I also have, I can share some slides after this so you can have all this information together, which is what companies have to do. As you also heard, group 1, 2, and 3, that's just naming categories of companies that have different rollout phases. The ones that are panicking are these group 1 companies who are larger, who have to do this, right away. And then it starts getting smaller from that on how and when you need to get ready. But to summarize, this has been happening for the past 5 years in different markets. Australia, look at that, spent 2 or 3 years doing consultation with Big 4 and Group 1 consultancies, and they've published a standard that it's really basically a carbon copy of what already exists under a different name. One last thing on that is that the name is climate-related financial disclosures. So there's a very big proximity to financial data, and therefore the people signing on this stuff is the CFO of a company and his director's liability in that. So think about sustainability individuals and a bit of that responsibility shifting to the finance team because this is financial related data associated with climate. I think that kind of sets it on. Alex, let me know if that's clear, but yeah.
That's perfect. I think that's a really clear picture as to sort of how it came to be and sort of the state of affairs right now. I'm curious, and we've got like mostly people in here that are individuals learning on their journey. We've also got an in-house tier one company reporter, Laura. Interested to understand from your perspective, Afonso, what are the typical companies that NetNada works with? Like what tiers are they? And what are the sort of core challenges that you're seeing, especially this year, as people sort of scramble to do their reporting that they're facing in rolling this out, that people in this group should be aware of as they're maybe getting deeper into the space?
Yeah, can I just share my screen?
Yeah, go for
this, or yeah, awesome. Let's see this work, and maybe then Laura can speak to it as well. All right, so I just want to share. It's not, my computer's a bit slow, so I'll just go verbally on this. But we've actually done on the back of a research piece with 60 odd companies, and we've also done 20 something interviews. And the question that we asked basically was, with all of this that you have to do, where are you struggling? And we surface that data on this report that we'll be publishing that can help two things. One is companies understand what it's ahead of them, but secondly, individuals who are trying to slot into these jobs to be done, to say how they can pitch their talent or their skills on the requirements that people are most lacking or afraid of or falling behind. So for context, the climate-related financial disclosure has 4 pillars. It has governance, it has strategy, it has metrics and targets, and it has risk. So governance, strategy, risk management, metrics and targets. We talk about carbon emissions a lot. That is, imagine if there's 200 requirements, only about 20 all of them actually talk about carbon emissions. This is your scope 1, scope 2, scope 3 measurements, and so forth. Everything else is something that is not related to carbon emissions. All right? Out of the research that we've done, people are most advanced in metrics and targets and governance. Governance is not the boring stuff, but policies, oversight and structure, board education, really corporate terms, and they're falling behind in strategy and risk management. Strategy involves things like scenario analysis, transition plans, opportunities, which you might not have to be an expert in carbon accounting. You just need to be able to, engage with stakeholders, service relevant data, understand industries, and so forth. And then when you go to risk management, same thing. Risk management is about risk register. It's about looking at competitors. It's about looking at physical risk, like, okay, where are my offices? Are they in Queensland? Queensland has floods. If floods happen in there, people cannot go to work. That's a risk for me. Or most of my overseas employees are in the Philippines. Philippines is having an increased an amount of natural disasters. Therefore, out of the 52 weeks, they can only work 45, as an example. Like, all this stuff doesn't require just being a carbon accountant. It requires understanding of climate in general, stakeholder engagement, being able to read policy, being able to look at competitors, and so forth. So to summarize, for the individuals that are trying to position themselves in the space is, okay, if I'm not going to do carbon measurements, which is normally the default, I want to work in sustainability, I need to learn about carbon. What are the things inside risk management, governance, and strategy that I can add my value into, and that can be very easy to cross transfer from different industries, because you might already have been doing strategy for ages. You might have already been looking at risk for ages as a risk professional, or in a leadership role. You now just have to put a climate lens on that.
That's super helpful, Afonso, in sort of understanding those 4 key pillars. And interesting to hear a little bit more around like sort of scenario analysis, as well as understanding risk registers and the like. I'm keen to dive firstly maybe a little bit deeper into scenario analysis. Like what does that look like practically as a professional engaging in that area? Is it like running simulations? Is it running like data models? What does that sort of look like? How many different scenarios do you need to sort of like account for in order to like hit ASRS reporting standards, but also maybe if you want to go that extra mile and really think strategically for your organization, could we get a little bit more of an insight as to like what that looks like?
Awesome, for sure. So scenario analysis involves 3 main components. The first component is that scenarios have already been mapped for you. There's different temperature curves that we can forecast that it will happen in Australia, and that might have different contributions. So in a different curve, you might have more climate extreme events, and the other one not so long. In one where you actually keep reductions, you have a heavier investment in technology and so forth. And these have been mapped, they have been sourced for the Australian context, and it's not for you to reinvent them. Your goal as leader of picking 2 of these scenarios and saying, okay, I'm going to pick the scenario where we stay within 1.5 degrees, right? There's some consequences to that. You're going to map what's called, and this is visualize a matrix in your head while you do this, a table, short term, medium term, and long term. You're going to sit out with your board, with your leadership, with your procurement team, your legal if possible. You're going to say, if things stay as is, do we have to do anything according to risks that we've identified? It's like, probably not, we'll be okay. And then if you go to medium term, where temperature has increased a little bit and you have more floods happening in Queensland, you might say, you know what, 30% of our customer base lives in Brisbane. If they have floods happening all the time, they might not have money to spend on our products, which are just a nice to have. Therefore, you're going to say this is actually a yellow risk on our matrix, and you should be on the lookout for that. And so you start producing these matrices based on your understanding of your business and the climate scenario that you've picked. You don't have to be a climate scientist to do these exercises. What you need is a deep understanding of your industry and your company and where money is coming from, your client base, and so forth. Because like I said, it's financial related. So it's more important to have the financial lens in your business understanding lens than just what is happening in terms of like climate data, because it has already been mapped out for you. The second part, which is more, and the third part, which is more like analytical driven, is when they ask you to measure the financial impacts of such scenarios. So in that case, you have to sit with your team and say, okay, if we imagine that in the long-term scenario where temperature goes up for 3 degrees, and let's say we are in the agricultural business, we can actually face 50% reduction in our production of wheat and soy, and therefore this will be the impact of such scenario. You might lose $20 million worth of sales. Let's say if you are in logistics and you look at the aggressive scenario where we actually reduce climate change, that might come with heavy investment into electric vehicles, right? Big fleets or hydrogen trucks. In that case, you say, well, we actually have a cost here that we need to migrate our fleets, and it's going to cost us $15 million over the next 5 years to change our fleet from fossil fuels into electric. That's what you're going to map out. Again, nothing related with doing climate modeling per se of like impacts of climate change. It's more about adapting that information into the business understanding. So really good for, if you think about if you have your consultancy or internally and you're doing that stakeholder engagement, it's about understanding that business knowledge has a bit more leverage and importance than just climate, because these things I've mapped out, and I can share some resources where these climate scenarios are and so forth afterwards.
Yeah, awesome, Afonso. hats off to you and how clearly you're explaining this. You're doing a really good job. This is an absolute masterclass. So I really appreciate the insights you're bringing. So I'm curious to hear from your clients, that have done their carbon accounting. They've established, their baseline on scope 1, 2, 3 emissions. Maybe they've done some scenario analysis and identified what their sort of core risks are. What sort of actions are you seeing your clients take to reduce their risk and try and mitigate the impact that they're having? And I guess further on to that as well, have you seen many of your clients begin to engage with their suppliers and their supply chains to try and point them in the right direction as well? Yeah, if you have any sort of stories on that, that'd be super interesting to hear.
Sure. Give me 1 second. I'm just gonna plug my computer. 1 second. All right, I'm gonna break that into a couple things. Some bad news and good news. The bad news is that most of the clients, and let's say like people out there that you think that they might be proficient in reporting sustainability, they have fancy and glossy reports. They've never done the mapping of what they're publishing against a standard. It's the first time. So the first step on this journey is actually what we call a readiness assessment, or some formal term, if you have more time, is called a gap analysis, where you actually go and say and answer the question, I don't know what I don't know. In a sense of, before I can go and do all these engagements, let's try to understand how far away I am for full disclosure. So that's where companies are at, just so you can set the context of how much engagement they're doing. The ones that are already actively trying to do stuff, the language is not as much as how do I reduce my impact, but they're going to have to set targets and metrics, and that's about how they're going to decarbonize their business, but also it's how they protect their business about this change. So a good example is, imagine you are e-commerce fashion brand. Let's say you're big, you actually manufacture your own clothes and so forth. You might have 3 main suppliers. Before, you might think, I have to engage my suppliers just to get their emissions data for my clothes. I want to have, tell my customers how many trees I have to plant every time you buy this shirt or these pants and so forth. Now it's changing for, I need to engage with my suppliers because I need to know what they are, and I need to know how prepared they are against, hurricanes, heat waves, electricity prices increase, and so forth. Because if that happens to them, right, it's going to impact my business directly. So it's not just about nice to have of transparency, give me my emissions data and so forth. Is I have 3 main suppliers, and 80% of my clothes come from 3 suppliers. If those people are not ready, it's going to impact my business. And lastly, defining something that sometimes it's not very clear. The user of this report, of this information, needs to be defined by the business, but normally it's investors, right? It could be banks that have given you a loan, it could be private equity, of course, can also be users. And now more and more is actually internal employees of the company who want to be part of a company who's doing the right stuff. But you have to think, if I'm an investor or if I'm an employee, do I want to work or invest in this business? I would only do that if I have evidence that they are preparing against rise of electricity, if it's coming from fossil fuels, if their overseas suppliers are actually being protected against natural disasters, if they have a plan to go and jump on a climate resilient pathway or line of products, all of these things to inform investment decisions. So it goes from more, hey, I also want emissions data from them, to have I shown enough that I've thought ahead, 10 years ahead, to position my business in a world where electricity costs 10 times more if it's coming from fossil fuels, if natural disasters are happening twice as frequent, if my customers are getting hit by insurance-related costs or flood-related costs more often, and does my business still exist if we are in that scenario?
Yeah, awesome.
Any questions on that or anything, please put in the chat so I can do less of a monologue and more of answering your questions.
Yeah. Yeah, keen to hand over to people that have shown up and are looking to get some insights from Afonso. So we've got a question from Laura. Are you encouraging clients to go further than the standard and look at double materiality rather than single financial materiality? So that's a question over to you, Afonso. And also, if anyone else has any other questions that they want to ask, like now's the time, either chuck it in the chat or put your hand up and you can ask them directly.
Laura, if you want, do you want to give your best attempt at defining for the audience what double materiality is? If not, I can do it, but up to you. Yeah, all right, I'll have a go. So double materiality, when you look at first what is materiality, it's a term that normally, if you're not in the corporate world, you might not hear it a lot, or sometimes it's just thrown around. Is it material? Yes or no, yes or no. Materiality is just following a method or a process to decide if something is relevant to your stakeholders, right? Stakeholders might be people who are relevant to your business, not just shareholders, but everyone. So you first define the stakeholders, and then you define if it's material. There's several ways to do that. You can look at, okay, if my competitor does it, so it's material to me. For example, if they report on scope 3, I should as well. If most of my costs are coming from logistics, then logistics is probably material for me. If I do a baseline analysis and I see that most of my scope 2 is coming from one office, or it's relevant that we use green energy, it becomes material. And you go to this exercise. Now, most of the materiality is done with the financial lenses. Is there a financial consequence if I don't do X, Y, and Z in a positive or a negative direction? The double materiality is when you look at the financial materiality, which has been done for ages when defining relevant topics in the business, and apply a sustainability or a climate lens on top of that. So now you don't only think about, does this have a negative impact on my business from a financial perspective? You think, does it have a climate impact on the world? And you put kind of the planet as your stakeholder, in a sense. Again, this is all with that climate lens, but that double materiality allows you to do that. It's not mandatory to do so, but it might help inform, because they're so closely linked, how your business plans into the future. My suggestion, back to Laura's points, I'm encouraging double materiality. People might not feel confident to do double materiality. I always say, we do harder things every day at work. This is not reinventing the wheel just because if it's a complex standard. And I think with a bit of upskilling and training, everyone can take and do that exercise with their stakeholders. Because if you're going to go through the exercise of getting the directors, the boards, your legal team into a room for 45 minutes or an hour, once every 2 weeks for 3 sessions, you might as well kill 2 birds with 1 stone and try to do it. Even if you're not going to publish, right? You might as well doing that exercise. Hope that answers your question, Laura.
No, that was great, Afonso. Mails has asked, what's the time frame for companies to do their climate disclosure, and who will be enforcing it?
Awesome. So Group 1 companies, like I said, there's 3 groups. Group 1 companies have to start reporting now. So based on their financial disclosure cycle, be it financial year or calendar year, they then have, I think, a month and a half or 2 months to then attach their climate disclosure. I don't want to say wrong information here, so I'll share the table that outlines the reporting dates and the criteria for that, so I don't get recorded saying wrong dates. And secondly, as well, which is relevant, is the assurance timeline, which is very relevant. We've talked about these pillars, these requirements, risk, scenario analysis, emissions. Not every single thing needs to be assured to begin with when you first report. It doesn't mean they don't have to be disclosed, but they don't have to be assured. So there's some priorities in that first year of disclosure. Most Group 3 companies and Group 2 companies are already trying to do the work because they're trying to save money. You might have a sustainability professional they're already upskilled on this and is trying to get their board involved as early as possible. Because if not, what's happened several times is sustainability team tries to do this work, even at Group 1 companies. The CFO doesn't get involved. The board doesn't engage. Timing gets a bit shorter. The CFO realizes it's their signature on the document, and they go, you know what? I'm going to pay Big Four to do this. I'm scared that you haven't done the right things. Sustainability team, thanks for your effort, but we're going to go somewhere else, right? And it's really discouraging. So the goal that we have is how can we empower and how can we have stakeholder engagement as soon as possible. So there's trust put on the sustainability team. They get resourced appropriately. They fuse with the finance team to get this going without having to just rely on an external consultant. But yeah, I will share the table with all the dates after this. Who's enforcing it? There's a mix. There's the mix for lacking on the disclosure itself, which I think will be ASIC, and then there's like the greenwashing claims who could be ACCC. So there's actually two types of who's going to be enforcing and checking on your claims.
Yeah, and ACCC have really sort of upped the ante, especially on the greenwashing side of things in prosecuting people. So definitely something to be across. Bex asks who created the scenarios that you referred to, Afonso, and how well do they keep up with the evolving science? Is that the Science-Based Targets Initiative or?
No. I don't remember the name now. I'll share it as well. They are an adaptation of the IPCC scenarios into the Australian context, and I think it's called something like Climate Risk Australia. It's a government-funded body that has done the research and adapted this. And I'm going to say they are very source of truth. I've spoken with several consultants from different firms, tier 1, tier 2 firms, and it seems to be the underlying kind of scenarios that have been mapped. It might be too high level for your stakeholders if needed. I don't think so, but you can also then go in deep dive into different ones or run your own analysis or outsource a different analysis on those scenarios.
Awesome. And then a last question, Meg has asked, are you able to share in a very high level explanation what the thresholds are for mandatory reporting? I think you sort of began to touch on that, but.
By thresholds, you mean things that need to be done, or what does good look like, Megan?
Well, I've come from the social pillar in modern slavery, so the threshold is anything over 100 million companies need to report. So equivalent thresholds for the ASRS.
Yeah, so the thresholds, I would love if I could share my screen, but my computer is saying no. But I'll read out of my table.
I feel like it might be a financial one.
It's a financial and an employee. So, for example, Group 1, consolidated revenue of 100 million and more, consolidated assets of 1 billion and more than 500 employees. So if you have to meet 2 of the 3 criteria. So not all 3, not all 1, just the other 2. And your Group 3 starts at 50 million and 100 employees. So what you see a lot is people, they are now going to Group 3 who are now maybe the next financial year taking over Group 2 because they've grown their business or they purchased new assets, a new hospital, a new whatever, that they went from 2027 to 2026. They get scared and the ball starts rolling. But yes, it's a financial and headcount threshold. There's a little different scope for asset owners and financial services like banks and so forth. Cool.
Awesome. Well, we are at time. Afonso, thank you so much for that very comprehensive crash course on Australian sustainability reporting standards and all the different sort of components that people need to be across. I'm sure people are very thankful for your time. Everyone definitely go check out NetNada if you're looking for an easy to use solution. But yeah, thank you so much, Afonso. I really appreciate it.
No worries. Look, any questions, just message me. We have 4 webinars coming up on this stuff in a sequence. They're not economy just yet. We might fuse together with Alex to deliver this content. But if you're interested, the next one is on the first pillar, and you've already done one on readiness assessment. But yeah, any questions, I'm here to help. LinkedIn, text. Thanks for being part of the economy, and Climate Crew as well if you're part of it. It's fantastic to meet you and get to chat with you.
Thanks, everyone. Appreciate your time, Afonso. Appreciate all your time. Have a great rest of your days.
Bye.
Thanks so much, guys.